So today we're here for hard money. What is it and when to use it? And I'm here with Kevin Amolsch. Is that correct?
Very close. Amolsch.
Amolsch. It's a
Nobody gets it. Yeah.
Okay, and he's from Pine Financial Group, and I'm going to introduce him a little bit later here. I want to welcome you to LeAnn Riley's Real Estate Investing Club. And just say hello. This is a live stream on Facebook and a live webinar. So we're really pushing the deck here. And I bring expert speakers and leaders in real estate investing nationally to you at least once a month. And during the pandemic, I was every week. Now I slacked off, just like kind of, our focus is changing, isn't it? Anyway, you get to ask questions and participate from anywhere. And the truth is, you don't need a ton of money to get started as a real estate investor. And that's what we're talking about today. You just need to know the right formulas, and you need to follow a system. And sometimes you need to know the right people too. And we're going to talk about that. So I'm LeAnn Riley. I'm a real estate broker and a real estate coach. And I lead the Encore investment team of realtors here in the Twin Cities, Minneapolis, St. Paul, Minnesota. And I built a multi-million-dollar portfolio in residential, multifamily, did some condo development, commercial, and vacation properties. And I'm a national coach and a trainer, and I help ambitious people build wealth through real estate investing with my proven profit formula coaching program. So, and here I provide free education monthly with my LeAnn Riley's Real Estate Investing Club. And I'm excited that you're all here today. We got quite a few people. And today is our guest, and now I'll say it again, Kevin Amolsch. Is that better?
Nailed it.
All right, I nailed it. Okay, he's the founder and the CEO of Pine Financial Group. And he's also the author of a book called The 45-Day Investor, and you can get it over there on Amazon. It's about 18 bucks. I looked today. And the book is How to Buy an Investment Property with Nothing Down in 45 Days or Less. Now that sounds like a challenge, to the average person, especially if you're not a real estate investor. I know it can be done though. And, looking at the table of contents in his book today, he even gives you a lot of the forms and tools and how to. It's in there, the system. So that'd be a great book. So Kevin is an expert at many things, but really real estate trends. He's been around the block and he knows. And I love chatting with him because I always learn something new. And he's also an expert at creative financing. And he has only a little tip of that in the book. It's the rest of it's still in his head, or he's using it to buy deals. And he actually dove into this business after spending 4 years in the U.S. Army. So thank you for your service. And he has now bought, built, sold, and financed, and he owns. He's done thousands of transactions, just as in the real estate investing, kind of the other side. And as a realtor, I've done thousands of transactions. So you've got two experts here today, and we're going to have fun chatting, aren't we?
That's right.
Okay, so I think the thing about Pine Financial Group, what I know is they have fix and flip loans. And I think a lot of people think that. And I have always sent someone who asked me, I say, you better go to one of their seminars and figure out how it works. And then they're great people to go get some money from. So we're going to find out about it. You know what? One other secret, you guys, check out the Pine Financial YouTube channel. They have great education on there. Every Friday you put one out, don't you, Kevin?
Yeah, every week.
Every week. And I loved the one just last week was, something about how do you find a good deal? And I think you said it, or maybe Justin was on there. A deal is a good deal whenever the numbers work. It doesn't matter if it's what the market's doing. It's when the numbers work, it's a good deal. I like that perspective. So a couple other things. There's a chat box for those of you who are on the webinar. And just remember, that's where you're going to put your questions. And it'd be great because we have a technical issue. It looks to me like I got about 10, 15 Kevins on here. So you put your name right before you put your question. Okay, and then we're going to try to answer your questions. But first, I'm going to ask you a lot of good ones. And then if I haven't covered it, you can post, okay? So before we get started, I'm going to take a poll, though, of who is listening here, okay? So you'll see on the screen, I have a poll here, and I want to know what type of real estate investing interests you so that we know who we're talking to, and you just make a quick vote. Okay, we got some how to get started. These are your main strategies that I have up here. Oh, they're voting, aren't they? It's moving around. Oop, buy and hold is winning. I'll leave it up for about 10 more seconds, and then I'll actually show you the answers here, okay? And this helps both Kevin and I know who we're talking to. And the winner is buy and hold. But we have a lot of how to get started people, and then a little bit of all the other categories. Oh, I can share results right here. There you go. Now you guys can see who we have on here. Okay. That's kind of interesting, isn't it? All right. Now, I got the big question. Let's get that off of there. All right, it's Kevin and I. So the first one, here we go. It is, you know, the economy is in this uncharted territory, right? And there's a world of chaos. We all know that. And there is a lot of fear. And you know what? Real estate investing has fear anyway, doesn't it?
Yeah, it does.
And so it's heightened, wouldn't you say?
When you say it's heightened, when you say that's a question for me?
Yeah, well, just that the fear is heightened. It's like people are unsure what's gonna happen. And we're gonna take a deep dive into hard money, real estate investing in the market, because that's the questions. So first, explain hard money. What is it?
Yeah, so I thought we were going to go into the economy there, and I was like,
not yet. We're going to go there, but first
I got some things to talk about with there. Okay, hard money. What is it? So, hard money is just really just jargon, right? There's not like it's not in the dictionaries, but in the real estate world, we understand hard money as being private capital, non-traditional money used to fund real estate transactions. So most hard money lenders will lend on rehab loans, fix and flips, fix and holds. Those are the most common, maybe some commercial value add stuff, but it's non-bank financing.
Okay, non-bank financing. The first thing I think in right away is, it's expensive.
Mm-hmm. Yep. Hey, look, I get that all the time. I understand completely. And it's sticker shock for sure when someone who doesn't understand the product and understand the tool as it should be used. So I'm glad that you put on something like this, LeAnn. First of all, I should say thank you so much for the invitation. And thank you to everyone that is here today live, Facebook here on the Zoom call, even if your name's Kevin Amolsch because of my mistake. Really appreciate you all coming out. I know you have lots of different things you could be doing, but you're here. So LeAnn and I, we're going to do our best to add the value that you're looking for. Kind of got off track there, but the thing about hard money is it's not traditional financing. So the sticker shock, that's where I was going, the sticker shock. So you're thinking about financing, you think about bank terms, right? 1% origination, we call that a point. A point is each point is 1% in a fee, percent of the loan amount in a fee. So on a $100,000 loan, 1 point's $1,000 for a lender fee. So you think about 1 point generally, and 6% in today's market as an interest rate. And then you see hard money and you're like, oh my gosh, this is 3 points, 4 points, and 12 to 15% interest. And that's a little scary. But as we talk through this today, you'll understand the value of it and why it's just one more tool in your tool belt. You don't need to use it. You don't use a hammer on a screw, right? So you're going to use the correct tool for the transaction that you're trying to put together.
Exactly. And it's all about the strategy you're working on. It sometimes, depending on what that is, doesn't matter how much the money costs. You know, I made a lot of money in real estate paying 18 and 20% interest. Guys, that was the mortgage rate. That was not private money. So it's all about whether you cash flow. So, okay, now then give us your typical customer. Probably the most is a fix and flipper.
Yeah, I think fix and flip is, well, I know fix and flip is definitely our most common borrower. And the reason for that, LeAnn, is because it's sexy. Right now, you just did that poll, and more people are interested in owning rental properties and building wealth, which that's great. And I'm glad that we're going to talk about that, because most people like the $30,000 or $40,000 paycheck, and that is attractive. And then you see it on TV, the fix and flip shows, and people really like those big paydays. The problem with that is you're on a treadmill. As soon as you sell your flip, your income stops. So you're back on trying to find the next deal. And so you're constantly running on this treadmill, and rental properties will create that wealth and that cash flow. So yes, to answer your question, my most common borrowers of fix and flip, but we do have quite a few buy and holds because of that Burr strategy that I'm sure we'll get to.
Okay, so that's interesting, because I know I've heard or thought hard money was only for fix and flippers, and it didn't really work for anybody else. So hey, already here's a trick. So when you are a fix and flip person, the key formula item is, so if you're buying it for 100, what's it going to be worth when you're done? They call it the ARV, or the after repair value, right?
That's right.
What do you want to say about that? Tell us something about that, or teach us something here.
Yeah, great. So the rule of thumb in the hard money business is 70%. So you'll hear it called the 70% rule. And what we're looking for here is you want as much or all of your costs to be at or below 70% of that ARV. So let's say we're looking at a $200,000 house, for example. And if we're using your example of a $100,000 buy on that property, the 70% rule is 140,000. So you're buying it for 100. That leaves you a $40,000 room. Now, can you get the rehab done for that? Can you get the rehab and your closing costs done for that? If so, fantastic deal. You're going to make a ton of money, and we're going to loan you 100% of that deal.
So you'll give us the whole 140.
Yeah. So I guess I probably went really fast there. The 70% rule is 70% of the ARV. So we always start with the ARV when we're analyzing real estate deals. So you take the ARV, multiply that by 70%, and then typically you want to subtract your repair number from that. And that's going to give you a real good range of where you want to be offering making your offer at. So again, it's ARV times 70 minus repairs, and that's kind of the range you want to be at. Got it.
So, I've heard, I help investors find properties to buy, and they're like, well, gosh, this is a good one. I should push it to the 80%. And I'm like, that's giving away your profit. Or I can't find any deals. I got to get this one. If the numbers don't work, the numbers don't work.
Yeah, I can't agree with you more. The one catch to that, though, LeAnn, is if we're going to switch over to the rental property conversation, because you can pay 80% and make a ton of money, because now we're more focused on the cash flow than the value.
Yes.
Right. So it just depends on how you look at the deal and what your objectives are.
Okay, good. We will switch over to that, but not quite yet. So what's the most important thing in a fix and flip?
Making money.
That is, because boy, it's a lot of work. I like your treadmill theory because that a fix and flipper has to have the next or the next coming. You're right.
It's
Unless
funny,
you're
people, they say, what do you do for a living? Well, I'm a real estate investor. Yeah, what do you do? Well, I flip properties. Okay, and you call yourself a real estate investor? I don't know. I mean, I understand the term, but that sounds like a job to me. High paying job. I'm not discouraging it, but it's not really investing when you're just turning.
yeah. If you don't keep any, if you keep some, now you're an investor.
Bingo.
And that's what, okay, so then I think there we can move right over to the Burr strategy. So tell us, how's the hard money going to work in this system?
You know, you and I, we've been doing this for so long. There wasn't even a Burr strategy when we were starting, right? We just kind of knew that if we could leverage up on a property, fix it up, and then take out that expensive money, then we would be getting into properties with little or no money. We just kind of figured that out long before the Burr strategy was actually the Burr strategy, long before you and I knew each other, right? But now it has this fun little term. So it stands for buy, rehab, rent, repeat, something like that. Refinance, repeat. So the concept here is to use someone like Pine Financial that's going to loan you as much as possible on your deal, up to 100%. So you buy the property, you fix it up, you get a tenant in there, you start producing some income, and then you refinance into a Fannie Mae or Freddie Mac type loan, pay the hard money back, and you could literally be into a project with, you know, little or no money down. That's one of the strategies we talk about in the book because it's so effective.
It's so effective. That I love that one. And my question is though, so let's say I want to do that and I find the right property and and I'm fixing it up and, you know, especially if I'm brand new, I always teach people, if you're fixing something up and you think it'll take 3 months, plan on 6.
That's right.
You know, just double whatever you think, and probably the amount of money you think, it's probably double that too if you're brand new. Because, and that's why so I'm curious, you know, if I'm going to do that, what's my time limit? How long do I have to get the private money to get that refi happening?
Yeah, and maybe we should talk more about the risks with the strategy also. But so to answer your question, we do a 9-month loan. So there is no reason you can't get done in 9 months if you're planning to refinance. Part of this strategy, and to stay safe in the strategy, is to get approved for that refinance first. You want to know that you have the ability to pay back that hard money loan before you ever buy the property. So as soon as you have it rehabbed and a tenant in there, you get your new appraisal, and then you should be you should be closing that refinance loan 30-ish days after the rehab is done. So you should be able to get it done.
Maybe I know too much, but can that be done on one appraisal? That, you know, like the original appraisal is for the fix up. So can we just have one, or do I got to have 2?
I wish I would take some of the risk out of it, right? So one of the biggest risks with this strategy is the difference of appraisals. Look, appraisals or appraised values, that's just somebody's opinion. And it's very possible, in fact, it's likely that 2 appraisals will come in a little bit different because there's 2 different opinions on the value of that property. So we do the absolute best we can to nail that value and our ARV value when we finance it, in hopes that your value comes in at or above that for your refinance. But if it comes in low, you either have to switch lenders, challenge the report, or possibly bring a little bit of money to cover any gap there.
But a little bit of money is nothing compared to had you have funded all that a different way.
Oh, yeah. I mean, especially with credit tightening, you know, it's getting harder to buy rental properties. So you're probably looking at 25% down with most lenders right now. Plus they don't finance repairs. So you got 25% down plus your closing costs, and you got to fund your own repairs to buy one property. Now, unless you're buying turnkey or something that doesn't need any repairs, but in that case, you're likely paying retail values because inventory's tight. Everybody's paying retail right now.
Or above. That's a great point. So it's a good, I guess I wasn't really promoting it to some of my Burr people, because it's kind of funny, we've been around a long time. When I just started hearing about Burr about a year and a half ago, that's when it got coined. I don't know if it's in the dictionary either, do you?
I think so. We should look that up.
Sounds like Alaska to me, but or Minnesota in the winter. Okay, so you're seeing a lot more people using the private money for exactly that, and right?
Yeah, it's slowed down a bit for the Burr strategy. Surprisingly, I'm seeing more fix and flips right now, and I don't know if that's fear with what's going on in the economy. Colorado, that's where I'm at and where I'm located. There's lawmakers right now that are introducing legislation that's going to potentially put a moratorium on evictions for 12 months. So if we see something like that pass, landlords are going to be in a bit of trouble. So I think maybe there's a little bit of a resistance to buying rental properties, and every state's doing things crazy right now. People are overreacting a little bit, in my opinion.
You don't have a moratorium right now? See, I'm just assuming every
small.
Okay. We have one, and we're just June 12th. What's that, 2 days, going to be lifted out of it, which, yeah, you're right. There's a little bit of people being timid right now, but I can't believe it. I took people shopping this weekend for a house, some buyers, and one day on the market, 20 offers. 20.
Yeah, and let me clarify that. We're seeing a pullback in rental property acquisitions. I don't have any data to support that. It's just what we're seeing in our office. That is not the same for fix and flips. Fix and flips are on fire.
See, that's interesting, because maybe sometimes what you read in the news, like us in the business, we're like seeing the opposite sometimes. Like I was seeing the opposite. Oh my gosh, it's going to be hard to sell right now. That's not what we're seeing out in the market. This is spring market, folks. And I heard or read, maybe July or August. It's June here, and it's spring market. It's multiple offers all over the place. You can't run fast enough.
Yeah, inventory's down across the board, except for maybe New York or some of the other cities that people are fleeing from. But inventory's down. Applications for new homes, they're up like 18% nationally from a year ago, before COVID was even it was always a thing, but before COVID-19 was a thing. We're up almost 20% on new home applications. That's very encouraging.
And building is, even new builds, here's one of my theories, people spent some time at home, and one thing, they fixed up their house. That's it. People who weren't working, a lot of them did their home improvement stuff, and they got to decide if they love their house or not. And so you're going to see a lot of transitioning, either smaller or bigger.
Yeah, and you're going to the new home route, and new home builders have slowed a bit. I've been tracking that pretty closely, and part of the reason for that is financing. And that's another reason hard money is so popular and such a good tool for some cases, because even these new home builders with their lines of credit are getting shut down. So there's a big pullback in the new home market for sure.
Well, the truth is, banks are worried.
Banks are worried, sure.
They're worried, and they are. My very first hard money lender, who helped me in my very beginning days in the 80s, he used to say to me, the doors are open or the doors are closed for mortgages. He was actually a regular mortgage lender, but he had private money too. And I always remember what Ben taught me, because that is so true. And right now at the banks, doors are closing, and that's when we have to use private money to get over the little hump. It will straighten itself out. Wouldn't you agree?
Oh, for sure. Yeah. I mean, we're seeing a pullback in things like jumbos, which doesn't really affect people on this call likely. We're seeing a pullback in FHA, which will absolutely affect, because we're flipping to FHA buyers. But those are low down payment loans anyway. And with the inventory the way we are, we're not seeing really a challenge, as you mentioned earlier, LeAnn, on the resale of it. Our
No.
challenge continues to be finding the quality product to fix up.
Yeah.
Without the inventory, it's hard for fix and flippers to locate the projects.
Well, and here I can speak to the Twin Cities market. And just so you guys know, Pine Financial lends in Minnesota and Colorado, right? Those are your
That's
two
right.
states. Yeah.
Yep.
So Kevin's real familiar with Minnesota, and Minnesota's kind of high in the news lately too. Anyway, but we have in the city of Minneapolis, they have tightened down on landlord rules, and the city's kind of got involved a little bit, and that's changing some people's opinion about holding in the city. Now, other people, one of the things they did at the same time is they opened up the zoning. And if you have like a single family, you can build up to a 3-unit on the same lot without a variance. So I think I remember talking to you about this, Kevin. They did this in Denver, didn't they?
Oh, yeah. Yeah, there's a whole rezoning of the entire city.
Yeah.
Because they want density. They need density. There's so many people moving in.
And you capitalized on that, didn't you?
Oh, absolutely.
See, you have to know which strategy to deploy at which time. Would you say
Right.
that's true of real estate investing? Yeah. So you're seeing a shift. And one other thing I saw related to COVID is people are maybe, I don't want to live in the inner city or in the tight apartment. Maybe I want a little space and yard and whatever. So there's a little bit of moving out going on.
Yeah, and that's a good point. We're seeing it definitely in New York and San Francisco. Those are the two big ones. I haven't seen much in Minneapolis or in Denver. In fact, the migration in is still insane. It's 100,000 a year in it. I mean, obviously we don't know exactly what it's doing through COVID, but we're not seeing, people leave really either market. I mean, there's definitely strength in jobs in both.
We have good markets. These are good markets. Yeah. So, what should we be doing as real estate investors? Like, you've heard it. There's going to be deals like coming. When is that? Here's what I keep wondering. When is that? And I read so many things. What do you think, Kevin? Because you're pretty good at predicting, and you have good reasoning behind this.
Yeah, and look, no one knows, right? We don't really know. Anyone that says they do, which is not very many, they're lying to you. We are shooting a video on our YouTube channel for this Friday about this exact thing.
Oh, good.
So I'll just go ahead and mention what we're likely be talking about in that video, and it's forbearance. So as long as there's forbearance going on, and if you don't know what forbearance is, it's basically a workout agreement with the loan servicer where you don't need to make your payments. And if it's a government supported loan, FHA, VA, Fannie Mae, Freddie Mac, all of those, if you're any of those, you get an automatic forbearance without any questions asked, without any documentation for up to a year. Now, it's not good because it will report on your credit, not as missed payments, but it will report as being in forbearance. So it won't affect your credit score. It will show up, and lenders are going to look down on that. But here's the issue with that. If all of these people go into forbearance, it's like 4.7 million right now in forbearance, and they all went in at about the same time. And we all know that they're 1-year terms. Well, what's going to happen in 1 year from March and April of 2020? So in 2021, March, April, these are all going to be expiring. And then there's going to need to be the workout. The good news is the loan servicers have the flexibility to work out payment arrangements. So it doesn't necessarily mean it's all going to come due at once. It doesn't mean it's going to be increasing payment size. None of that. It could literally just be the same exact payment, just pushed onto the end of the loan. There's some question marks around the escrows, the taxes and insurance that the servicer continues to pay even though you're not paying. But overall, it's probably not going to have a big, giant impact unless we can't get people back to work. If people are not working, then we might see an issue there. But I think that's the crash that people are claiming is coming. I can't see anything else with all the stimulus and with people not even needing to make mortgage payments for a year. So I don't know what you think, but if we see something, it's not going to be for at least a year plus a foreclosure process of another 6 months. And even then, I don't think it's likely.
I'm leaning the same way. I don't think we're going to see it. You know, the last crash was bank related. This isn't. This is a pandemic.
Right.
This was not caused by the same improper lending. You know, this is different. And if you keep reading, you know, housing is going to lead the comeback. And look at it already, you know, it's and our inventory is low. Thank goodness for that right now with everything else happening. It's going to keep all of us who do own property, things are going to, you know, we're not going to like lose value all of a sudden, that kind of thing. It's keeping the prices up. So that's good. In fact, they're rising, you know, it's amazing, you know, and I'm not worried either. I think they'll figure out that forbearance stuff. And when you add it on the back, you know, I was encouraging everybody through my newsletters or however I communicated to, you know, if you don't need to do it, don't do it. Because at first some people were saying, hey, why not? And then it was like, no, wait a minute. If you want to go buy a new house, probably not good to have that, you know, you got to think ahead. What about when you want to buy or move? If that's on your record, it's not going to be pretty. You'll pay.
Refinance. So just a refinance.
I know. Refinance is even hard right now. It's amazing, right? We have a question. Somebody with forbearance, does that include delaying interest payments?
Yeah, that's exactly what it is. So a forbearance agreement is an agreement between the loan servicer and the borrower to not make the payments. So it could be a deferment of the interest. It could be, I mean, it's always a deferment, but it could be until the end of the loan or just till a certain date when they added on to additional payments. There's a wide range of workout solutions, but a forbearance by its nature means you're not going to need to make the payments for a period of time.
And if they tack it on the end, I think people are thinking, well, might as well have them do that, you know, but.
Right. But let's collect some rent and not make my payment. Sounds amazing.
Yeah.
But there's some downsides. So
there is downsides, and that's what, you know, we're not sure of. So if you can avoid it, avoid it. And, you know, I just put a post on Facebook too. As a landlord, if your tenants aren't paying, use your resources and provide, like I found a resource in Hennepin County. If the tenant is unemployed or not getting unemployment, the county will pay their rent right now.
Wow.
So I put the link, because if you're a landlord, share that resource with whoever is having some issues, and then everybody wins.
Yeah, that's fantastic.
Yeah.
We don't have that in Denver.
That's going on a lot of places. So responsible landlords, you don't just sit there and wait. You're responsible about working out an agreement, and then something is happening. You know, you're keeping the flow of money going on your projects. So okay, let me see here. You know, tell us about your best deal you've ever done.
Personally?
Yeah, I'm curious.
Yeah, my very best personal deal, we just wrapped it up like 2 months ago, right before COVID, maybe a week before the last unit sold. So I did a lease option on a fourplex 10 years ago, a little over 10 years ago. And it was in a good neighborhood in Denver. It's called Sloan's Lake, which is a real short drive to downtown. And so I had this and I subleased the 4 units out, and I was cash flowing over the last 10 years. But I was watching, as we talked about earlier, we were watching the density in this area. So I figured out what I could do if I acquired some of the pieces around me. And I started knocking on doors, and I found the neighbor on Facebook. Actually, I sent him a message, and we ended up negotiating a deal, and I bought the next door neighbor's house. And then we ended up buying a small sliver behind it. So anyway, we bought a handful of properties, assembled it all together, and we built 13 units. And that was my first 7-figure deal. So I'm really proud of that one. And we just got out of that, like 2 months ago.
So you sold it, you built it all and then sold it.
We built it and sold it. That's right.
So really it was a heavy duty fix and flip. No, it was a new development. So you actually developed a complete project from start to finish.
Yeah, we took down a fourplex. We took down a single family house. We assembled like 5 lots together. We built 13 townhomes.
Wow. Oh,
and we sold them.
townhomes.
Yeah.
And then you sold each one separately?
That's right.
Okay. And the last one sold right before this happened.
That's right.
And that was your best. Okay. Now there's something for us all to aspire to, right? And now I want to ask you, okay, somebody wants, can you post that link in the Zoom chat? Which link are you wanting, Dean? I'm not sure.
The rent assistance, probably.
Oh, it's on the LeAnn Riley's Real Estate Investing Club, my Facebook group. You know, I have a Facebook group free to join. That's where I posted it, but I'll get it to you. I know you. That's good. Darn it, I had a good, I want to know your worst deal.
You know, I should also say my best deal is probably my first one, right? I know that there's a lot of beginners out here, right? That's a little cliche, but man, if you're just beginning, your first one is your best one because it gets you in the game. My worst deal, oh gosh, LeAnn, I got so many of those.
See, just hear that, you folks. Not every deal is perfect, but you get through them and you learn, right?
That's right. I mean, my biggest loss deal was a hotel I bought in Branson. It was 23-unit hotel. Most of them had kitchenettes or kitchens. So I thought it would be a real easy conversion to an apartment. Price was right. The numbers were solid. I talked to management companies about vacancy rates, double checked all the numbers. And then I went in and I bought it and was going to convert it. Well, the problem is when you convert from a hotel to a regular apartment, there's all kinds of permitting, and we actually got denied. So we weren't allowed to do that. We had to keep it a hotel, which comes with sales tax and higher property tax and all of this. And then turns out the management company was telling me what I wanted to hear, not what was actual numbers. So vacancy rate we thought was about 10-ish%. Turned out to be about 40%, and because we had to operate it as a hotel. So I ended up just selling out of that one, and now I'm a proud owner of a 1-acre lot on Story Lake near Las Vegas, New Mexico. I didn't know that there was a Las Vegas, New Mexico. So I traded for the down payment a lot, and then I carried back a note, which is supposed to pay off next week. But all in all, I'm going to lose $170,000-ish on that deal.
Yep, it happens. You know, I have my share of horror stories too, but you know, it didn't take me down, and I learned. And you know, one of the bad ones was something relative to that. I got lied to in the information from the seller, and then purchased something based on what I thought, and it wasn't true.
Yeah. It's same thing, right? I got lied to by the management company because he wanted to manage the property. And
yeah, so you really do have to do your due diligence. Right?
Or have a great hard money lender behind you, because you know what? We don't want to lose money either. So we're going to try to help make sure it's a good deal.
You know, that brings me to something else about hard money. You know, what if I get a loan from you and, you know, whatever, a tornado or a pandemic happens and I can't get my rehab done in time and now it's due? What happens?
Yeah, so that's an interesting one because of what we're going through right now, right? This pandemic has caused some financial pressure on people. So we've had to work with clients, obviously. To answer your question directly, we write our loans 9 months for a very intentional reason. And we used to do, when I was just getting in this business, every hard money loan that I knew was 6 months. And then you'd have to extend. I don't know how it was like when you were getting started, but 6 months was probably the most common term for hard money. But the problem is people are taking 6.5 or 7 months to fix and flip the project. And then the hard money lenders cashing in on extension fees. And you know, we really believe at Pine Financial, all of us, we really believe that we're not going to succeed in this business if our clients don't. And that sounds cheesy probably, but it's true. If you're successful as a real estate investor, and it's partly because of Pine Financial, you're going to say good things about us. You're going to refer your friends to us. And I'll tell you what, you're going to do more deals to make more money. You're going to come back.
Yep.
So it's absolutely essential to us that you make money. So we wrote our loans for 9 months without any extension fees or anything, just to give you that extra time. Now, does it occasionally happen where you need even more time than that? Yes. If your head is in the sand, we're going to have to hammer you, right? We're going to charge you the extension fees and the higher interest rate
Yeah.
and all that. But if we have an open dialogue and I can understand, hey, I got held up in the city, I had trouble getting materials because of COVID, or something that's a little bit more outside your control, absolutely. Let's just have a conversation about it and work through it.
You know, and that's why I always teach, people always, you know, they find a hard money lender online. And I say, you have to find someone that you're going to deal with that you can look in the eye. That's what I say, because if you can look them in the eye, that means you can have a human conversation. If you know, and they can help you, because you've seen lots of deals. You can help if someone's struggling, if they at least come to you.
Yeah,
But if
absolutely.
it's a phone number and you don't know who you're talking to, where are they going to be when you need help, right?
Yeah, and you know, a lot of hard money lenders are funded by loans from banks. We have a very, very small amount. We're mostly equity. We make our decisions in-house. We service the loans in-house. But if you have a hard money lender that's either brokering the money or getting the money from a bank, they have somebody else to answer to, and they might not be as flexible if you do get yourself in trouble. So I guess that would be another word of caution when you're just calling out of the phone book, especially these national guys. They've got big hedge funds and banks behind them, and they don't have the flexibility that you might need if you get yourself in trouble.
Totally. Now explain to us, how do you use hard money like as a bridge loan?
Yeah, so when you think about bridge, you're thinking about a means to an end. So you have this property and you want something to happen to it, but you can't get it to that point without a little help. So the Burr strategy is a bridge strategy. You want your permanent Fannie Mae loan in place with the low interest rate 30-year loan, but you can't qualify for that because the house isn't habitable. So you need to buy it, fix it up, make it habitable, and then you can get the permanent loan. So that would be a bridge to your permanent loan. We see bridge opportunities in land. Here's another great example. A lot of banks won't lend on land unless it's fully entitled, because there's a lot of risk in government, especially in cities around and in Minneapolis. So we want fully entitled lands, right? But if we're at a good, solid loan to value and we have some confidence in that entitlement process, you know, a bridge lender will come in to fund the land, help you get through the entitlement process so that you're bankable for the construction loan.
Yep.
Commercial, we see a lot of value add commercial. So a property that's not stable, like maybe it's an apartment complex that's 40 or 50% rented. Well, a 50% vacancy rate is a non-performing asset. And so it's not financeable with traditional money. You need to get that vacancy rate down, your occupancy up, and then you can get the financing. So those are good examples of bridge financing.
Right, and hard money is a good option there. We got a great question here from Dean again. Is there typically a seasoning period with the bank to refinance out of this hard money deal? Do they want you to have it for a certain amount of time?
Yeah, that's such a fantastic question. And the answer is no, but let me explain that a little bit more. Fannie Mae and Freddie Mac have no title seasoning guideline. A title seasoning guideline is just as you described, LeAnn. You need to own it for a certain period of time before you can refinance it. And that's the only reason you got to hold it, is to use a new appraised value. You can refinance at any time. You just can't use the new appraised value. They're going to give you the purchase price as the value. So Fannie Mae, Freddie Mac, no title seasoning guideline, but Fannie Mae, Freddie Mac, they don't originate loans, right? They buy loans, they own the loans, but you're not going to originate one from them or make your payment to them. So you're going to go to like a Wells Fargo, for example. I know I pick on them a lot, but you go to Wells Fargo and they're going to originate the loan and then they're going to sell it to Fannie and Freddie. They'll keep the servicing, so you keep making the payments to them, but they sold the loan to Fannie Mae. Okay. If Fannie Mae will buy the loan with no title seasoning, they could originate that way. But the problem is they absolutely need Fannie Mae to buy that loan. It's 100% essential, because if they keep making loans and they're not getting them off their books, they're going to run out of money and they're going to be out of business. So they want to keep originating loans, keep generating those fees. So they will tighten that a little bit, tighten those guidelines a little bit, just to be sure that Fannie buys it. So we call those lender overlays.
Yep.
The most common lender overlay is title seasoning. So when you pick up the phone and you call your lender and you say, hey, I'm going to do this Burr strategy, and they say, well, you got to own it for 6 months, you got to own it for 12 months, that's an overlay. So the advice to you would be call another lender.
Because they don't all have overlays.
That's right.
This is, I think the larger banks have more overlays than the smaller credit unions, or that's what I say.
Yeah, and there's some direct to Fannie, good lenders like Leader One. I know in Minnesota, we work with Kim Burke quite a bit, and she's direct to Fannie and she doesn't have the overlays.
Yep.
So that would be at least one resource to consider.
Oh yeah, we all know, I know Kim, you bet. Exactly. You got to go where there isn't the overlays, because otherwise, sometimes it happened to me back in my early investing days. It was a big bank. They promised, yeah. And the day of the closing, right there, they told me you don't get no, we're not going to do the deal. And it's like, you couldn't have said something sooner,
That's happening right now. We're seeing that right now.
Yeah. Yeah, and I'm hearing from some of my people that they're even starting to kind of call in some things from some of the commercial deals that the bank already has funded it, but now they're saying, so you got to really be careful now. And I've also heard other people who are stalled, they were supposed to close a month or two ago on that refi or that thing, and it's not happening.
Yep. I'm hearing it all the time. And in fact, our business has benefited from this because other hard money lenders and banks that do some construction financing have pulled back. So, people have good product under contract. They want to do the project. And so they're calling someone like us and we're getting it done for them.
Okay, we have another question here from Gopu. I have rollover IRA, but can't invest in my own properties. Do you loan against an IRA?
So when you say loan against it,
I think he wants to use it for collateral, maybe.
So that's illegal. We can't use the IRA as collateral. The IRS prevents that. In fact, they're so strict on that if your IRA borrows money, which I think might be the question, you can't personally guarantee it because there's a conflict there with any personal liability from your IRA. So the IRS really protective of IRA money. So we can loan money to the IRA to go out and do a transaction, but we can't loan you personally money and use your IRA as collateral.
But even if you loaned it, can you loan money to a self-directed IRA?
Yeah, absolutely. It has to be a self-directed IRA, and that
right.
The IRA has to be the one buying the asset because we are going to use the asset as collateral. We have no personal guarantee, so we need enough collateral to make us feel safe in the deal.
But that self-directed IRA, you can't personally work on that property. That's right. A hands-off transaction so there's a lot of rules to follow for that question.
Yeah, but if you have money in your IRA and not personally, and you find a good fix and flip, absolutely, you could do a fix and flip in your IRA. There might be a tax, or that if you're using financing, for sure there'll be tax liability there or a taxable event. But hey, if you're paying taxes, it means you're making money. So I would say don't be afraid of that. Right,
and that's why people put their money in the self-directed IRA. Yeah, to just do it all in there, and Okay. Here's another thing that was in your book. I love it. You say, turn your investing into a business, and you say 3 things, so you say, get a mentor. Okay. So I'm curious, who was your first mentor?
My first mentor was a guy I met at a real estate investor conference. The conference was about entity creation and it was taught by an attorney here in Denver. And the guy's name was Chris. I met Chris at the event. He was a successful investor. This was more of a higher level event that I was attending, even though I wasn't really doing a lot of transactions. I was doing a handful of lease option deals, but I was just kind of getting started. He liked me. We connected, and maybe 2 weeks later, I came across a deal where I didn't know how to put it together. So I called him. took me under his wing. We went out to the property. We negotiated. We sat down in front of the seller. We negotiated with the seller, bought the property, ended up making 34 grand. We split that. So it was a good deal for him because I brought him the deal, but it was a great deal for me because he helped mentor me through the project. And then we did a handful more projects after that. So he was my first mentor.
See, and we all have people like that. And one of my hard money guys was one of my first mentors. And you don't even want to hear how good the deal was.
Maybe I do.
Like I mean, I gave him $1,000 and we met at a bank. We didn't even have a title company, did a quit claim deed. And I paid him after I did the rehab, no interest, no nothing. And, it was really great, and I think we all need help is what I'm trying to say. And when you get over the first hump, you're on your way. Another thing you said in the book about how you turn it into a business is by being in masterminds. Are you in any?
Yes. So I've always believed in masterminds and I've participated in them. And I was recently in one that was meeting once per month. It was really high level CEOs in different industries. And we would meet live. It's called the 12 Mavens, and there's supposed to be 12 CEOs. Well, the guy that was leading it left and the group started dwindling, and then COVID hit and I kept trying to stay involved, but the video and it just felt weird. And then he was bringing groups together. So there was like 20 people and it's just too much for a mastermind. Yeah. So there's a new one that I'm attending now. It's on Wednesdays, but I'm not as committed right now. I'm just trying to get through the COVID and everything. Yep. and hoping we can get back into live events and then I'll start again. But yeah, absolutely. There's no bigger value, you guys, than mastermind groups. And even if it's 4 people that don't know what they're doing and you're meeting once a month, at least you're holding each other accountable and you're supporting, loving each other. And I think that's what's going to help all of you grow. Absolutely. One other thing you mentioned in there is, and this, I thought this was great about real estate, you have to control your emotions. Yeah. And I love that because, that's kind of a skill I teach my own agents. We're helping people. They have all these emotions. And we as the agent, we got our own too, believe me, but we're in charge of simmer that baby down, whatever today's crisis is, because there's a lot of things. You'd be surprised what goes on behind what you folks see, what we realtors deal with, and how much massaging we do of the deal behind the scenes. And we have to control our emotions just as the investor and that fix and flipper when things go wrong. This isn't a perfect business, but it's a lucrative business. And controlling your emotions is important. I love that one. Yeah, thank you. And we're all challenged by that. Especially real estate is an emotion. It's like money. It's an emotional, tangible thing. There's a ton of emotion around real estate. People love it. The problem is, real estate's just the commodity for the business. The business is numbers, right? It's dollars and cents, just like everything. So we use real estate to make the money, but absolutely we got to try to keep that emotion out. And it's tough, isn't it? It is. And we got to know our formulas or we goof up on because it's formulas and you better know what's supposed to be what, and or you make bad mistakes in this business. So anybody else, I had a lot of good questions, so I hope that I'm covering what you would have been asking, Kevin, but go ahead and put your questions in there. We got time. The other thing you said in your book is pick a strategy. And it's important, isn't it? Yeah, in fact, one of my biggest, that's just going off a little rabbit hole there. I could tell you about my biggest mistake if you'd like, but one of the mistakes I see a lot of investors make, in fact, I'll broaden that. What I see entrepreneurs make is the shiny object. It's so challenging to stay focused. And you see a business opportunity you see an investment and we're just like chasing like squirrel, right? We're chasing whatever we think is the next thing and we end up making less money. Now, when we focus on something, even if it's a little bit boring and we get really, really good at that, that's when you're going to make the most money. I've seen it over and over and over. So when you're starting out, it's like going to Costco and you're going to try everything a little bit. I think it's okay to put the different strategies on a platter and try a few, but as soon as possible, pick a strategy and focus. If it turns out not to be the right strategy, which is exactly what happened to me, I started in this business in short sales and foreclosures, and it turned out to be the wrong move for me. So then you shift and you go to the direction that's right for you. It's easy to move or steer when you're moving, but if you're not moving, so I'd say, yeah, focus, not broad. That'll make you a lot more money.
You know, I've always taught people to combine strategies, and that's why, like Burr, that's exactly that. It's combining a couple different strategies, you know, because you're going to hold it. You're doing a buy and hold, but you're kind of doing a fix at the, you know, it's a combination, value add and buy and hold. So, but boy, you better know your strategies, because shiny object is totally it.
It's real, isn't it?
It's real. Yeah. You know, the other thing, folks, you know, in Kevin's book, there's all the actual forms and the system, you know, and real estate is a system. Making money is a system, right?
That's right. Yeah, in that book, I think you mentioned 18. I think that's true for the printed copy, but the Kindle is like $8, so it's super affordable.
Okay, yeah, yeah, I get it. You know, now Dean's got another question. How long does it typically take to obtain a hard money loan on a project?
Yeah, good question. So there's a lot of variables with that. The first one being access to the capital. So we're not banks, right? Banks, and we just found out today that banks are going to keep interest rates at or, you know, near zero through 2022. So banks can, and that's the rate that banks borrow at. So they have unlimited access to capital at 0% interest rate. So if you request money, they have it. Now, hard money lenders are a little bit different because we have access to capital and maybe a line of credit or something over here, but it's not unlimited, right? So if we have access to capital, you call us first to say, how's your capital looking? We can close in a day or two with the right loan product. That's our 90% acquisition loan. No appraisal requirement, none of that. We just, boom, close. If we need to get the capital, it could be maybe a week, 4 days, 5 business days, something like that. Now, if we're doing a full rehab loan, that's our flagship loan, if you want to call it that. It's where we loan 100% of the purchase and repairs. We need a full appraisal in our file for that, for when we get audited. There's some regulation around this business. So we get a full appraisal, and that slows us down a little bit. So we might be looking at closer to 2 weeks on a loan where we're going to fund the repair money also.
So 2 weeks from when they bring all the numbers, considering they're all there.
Yeah, once they bring the contract and the scope of work. A scope of work is basically your budget with, you know, broken down plus a little summary of what your plan is with the house. We need that so we know how to value it. And you can get that spreadsheet for free on our website in case anyone's interested in what does a scope of work look like. But yeah, we need the scope of work and the contract before we can get started.
Okay. And, you know, do you provide then you know, I'm a realtor, I'm like, where's your pre-approval letter?
Yeah,
so,
absolutely. Yeah.
They're going to have that, right?
It's free. It's everyone should do it right now. As soon as we get off this call, it's pinefinancialgroup.com. Fill out the pre-approval, and it doesn't cost you anything. We don't pull credit or anything like that. We just want to see that you have a little bit of liquidity. That's what we're looking for. And we can talk more about the guidelines here if you'd like, but
yeah, go ahead.
Okay, so primarily what we're looking at is the real estate, right? We want to make sure that it's a quality, profitable deal for you. And that helps keep us safe as well. We don't know that necessarily because you're getting pre-qualified in this example. So the next thing we're going to be looking at is liquidity. Do you have enough money if there's a problem to handle the problem? I don't want you to go over your budget and I end up with a house, right? We want to make sure that you can handle an issue. You mentioned earlier in the call, LeAnn, that chances are it's going to take longer and cost more. Well, that's absolutely true. So without liquidity, you go out of business. So we're looking at $10,000 or 6.5% of the loan amount, whichever of those two numbers is higher as the minimum liquidity number, and then we'll finance the deal. You keep that in the bank just in case you need it. So pinefinancialgroup.com, there's an apply now. It's on the right-hand side of the form, actually, I guess this is your right. And then we'll give you a pre-approval letter that's generic. So it doesn't have a property address or loan amount on it. So you could use it over and over and over for all your offers. Again, that's free. So it makes sense to just do that.
Okay, so I found the house. I got my pre-approval letter. I found the house or the whatever project. I got my scope. I got all my paperwork together. I take it to you, and pretty much in 2 weeks we can close.
Yeah, exactly. Yep. So there's a process
Pending
here,
all
right?
the numbers work and everything, and you can get that appraisal in those 2 weeks?
Absolutely. Yep. So
Okay.
we have good relationships with our appraisers, and they push us to the front of the line. They're not going through an appraisal management company, so they don't have all that, noise around them, and they get paid right away, and they enjoy it, so they want to keep us happy. So it's a good win-win. But yeah, we'll ask for some stuff signed, and you have to send in your bank statement and that kind of stuff. But yeah, 2 weeks.
Your appraisers are probably much more experienced actually in ARVs and that, because sometimes a regular appraiser, that's not what they do all day long. So they might have a harder trouble, where if you are using the same people, they get it.
Yeah, and it's confusing. It's weird, but it is confusing to some appraisers. They start pulling in foreclosure comps and that kind of thing. So
that's what I mean, and then it doesn't work.
Right.
Yeah. I hope that answered your question there, Dean, of describing the process. Look at, we're at 5:01. I want to say, to wrap up here, because I like to end on time, because I could go on and on talking to you, Kevin.
We can do that.
Okay, so I'm going to share screen here, and I will put up Kevin's information for you. But first I'm going to say, if anybody wants to talk real estate with me, I do free strategy sessions, and you can schedule them. There is a link there, or you can just go to my LeAnnRiley.com under, and you'll find it. There's a link there, and you can schedule with me. And then I have Kevin's information here. There you go. This is how you contact Pine Financial Group, and certainly go to their websites. Is it just pinefinancial.com?
It's pinefinancialgroup.com. Yeah, that's how you'll fill out the application.
Oh, I got it right here at the bottom. Yeah, I got your email on there, or I hope it goes to the office.
Yeah, so that phone call or that phone number will go to somebody else.
Okay.
But that email will come directly to me, and I respond much better to email. I don't actually take a lot of phone calls. I'm busy, so it's hard for me to stop what I'm doing and take phone calls. So email is going to be a little bit more successful.
Okay, great. All right, now I think we handled everybody. So I just want to thank everybody for joining us today. And a lot of the people did come straight from Kevin. You can, again, LeAnnRiley.com is where you can look up my real estate investing club is there. And actually, if you join that, you'll be notified of my speakers every month or more. So, all right, John says, thanks, great chat. So I say the same thing. Thank you, Kevin, for taking the time today to explain hard money and the Burr strategy. And I'm sure some people are going to be giving you a call.
Yeah, I know we got a little off track with the market, but there's a lot going on. So I appreciate the opportunity, LeAnn. And if anyone has questions about hard money, feel free to email me and we'll get them answered for you.
All right. Talk to you soon.
All right. Thanks, LeAnn.
Bye-bye.